3 years ago, think pieces were being written about San Francisco's impending collapse. Today, houses there are selling for 70% above asking price. Not listing price, asking price. The same city that couldn't give away office leases in 2022 just posted the hottest residential market in the entire country. Let that sink in for a second. Stay with us, because by the end of this video, you'll understand exactly why some of the smartest engineers in the world are buying homes right now before their companies have even filed an S1. Here's the core tension. Demand in San Francisco is exploding, fueled almost entirely by AI wealth, but the supply side looks like a production outage nobody can fix. The number of available listings compared to the number of buyers is so lopsided, it's basically a race condition, and prices are the segfault. Median house prices have climbed roughly 23% in a single year, pushing toward the $2 million mark. The last time the market moved this fast, people were still arguing about whether NFTs were an asset class. If that stat just made your stomach drop a little, hit like. It means the algorithm works, and so does your financial instinct. Now layer in the demand side. Roughly 2/3 of all homes that sold last month went above asking price, the highest share in nearly 4 years. For standalone houses, that number climbed even higher, closer to 3/4. And here's the independently researched detail that puts this in context. San Francisco was one of the few major US metros where population actually declined between 2020 and 2023. The doom loop narrative was everywhere. Remote work, tech layoffs, crime. The story wrote itself. What nobody modeled was that the AI boom would essentially run a hard reset on the city's economic identity inside of 18 months. Most tech cycles take a decade to reshape a housing market. This one took less time than a typical Series B round. We break down markets like this every week. Data, no spin. Subscribe if that's how you like your real estate intel. The second layer is where it gets structurally interesting. Most of the buyers driving this market haven't cashed out yet. They're employees at private AI companies. Well compensated, paper rich, but not technically liquid. And the conventional real estate advice, save up, get your down payment together, wait for the right moment, it is hilariously irrelevant when your net worth lives inside a cap table. So what are they doing? They're borrowing against private company shares through specialized bank programs, using secondary market sales, or accessing unsecured bridge loans underwritten against their entire financial picture. Here's the kicker. Some of the biggest banks in the country have quietly built entire product lines specifically for this type of buyer. Private wealth is doing what it always does. It finds the path around the wall the rest of us are staring at. Serious question for anyone watching. If you had significant equity locked in a private company, would you borrow against it to buy now? Or would you wait for the IPO? Drop your actual reasoning below. I'm curious how this community thinks about it. Here's the twist that the headlines are mostly missing. The IPO wave hasn't even arrived yet. What we're seeing right now, the bidding wars, the all-cash offers, the luxury closings at record volumes. This is the appetizer. Multiple major AI companies are expected to go public within the next 1 to 3 years. And once those lockup periods expire, typically 6 months post-IPO, an enormous volume of newly liquid capital will be looking for a place to land. Buyers right now are essentially front-running their own colleagues. They're buying today specifically because they believe their coworkers will be buying tomorrow at higher prices. It's basically insider trading, except for houses, and entirely legal. The market is pricing in a future that hasn't happened yet, which, if you've ever watched a high-conviction tech stock run before an earnings report, is a pattern you'll recognize immediately. If you're an agent, buyer, or seller trying to actually navigate a market this complex, our team at Big Data Realty runs the numbers, so you don't have to guess. That's what we do. So what does a rational, analytically minded person actually do with all of this? First, don't benchmark San Francisco against national averages right now. They're measuring completely different things. The national market is flat to slightly down. SF is up nearly a quarter in a year. They share a country, not a market dynamic. Second, if you're a buyer, understand that the competition isn't just other buyers. It's sophisticated capital with instruments most people don't even know exist. You need to know what financing tools are on the table before you make an offer, not after. Third, if you're a seller, the data says you have pricing power, but inventory is the variable that could shift fastest if macro conditions change. The wild card, rising geopolitical tension and its downstream effect on inflation and rates, could interrupt this rally faster than any fundamental housing metric. Don't confuse momentum for permanence. San Francisco was declared dead 3 years ago by people who confused a cycle for a collapse. The AI economy didn't just revive it, it's rewriting the valuation model entirely. We're Big Data Realty. See you next video.